Ever wondered what ETFs and mutual funds are all about? Do they sound like complex financial terms that only Wall Street pros can understand? If you're nodding your head, don't worry, you're not alone. Many of us are in the same boat, puzzled by these investment terms. But here's the thing, these aren't just for the financial wizards on Wall Street. They're for anyone and everyone interested in growing their wealth. ETFs and mutual funds are powerful tools in the world of personal finance and investing. They're like the Swiss Army knives of the investment world, versatile and practical for a variety of financial goals. Whether you're saving for retirement, a new home, or even your child's education, understanding ETFs and mutual funds can help you navigate the investment landscape with more confidence. Well, worry not. By the end of this video, you'll have a clear understanding of ETFs and mutual funds. First, we dive into the world of exchange-traded funds, more commonly known as ETFs. Imagine a basket of financial assets like stocks, bonds, or commodities. Each basket is unique, containing a mix of these assets. The variety in each basket represents different sectors, industries, or even countries. Now imagine buying a piece of that basket. That's essentially what an ETF is. It's a type of investment fund and exchange-traded product, traded on stock exchanges, just like individual stocks. So how does an ETF work? Well, it's quite straightforward. ETFs are created and managed by financial institutions. These institutions buy assets, create a fund that mirrors a specific index, and then sell shares of that fund to investors. As an investor, when you buy a share of an ETF, you are buying a piece of the basket, not the individual assets within it. One of the primary advantages of ETFs is diversification. Instead of putting all your eggs in one basket by investing in a single stock, you're spreading your investment across a wide range of assets. This can potentially lower your risk. Another advantage is liquidity. ETFs can be bought and sold throughout the day at market prices, just like stocks. This offers you more control and flexibility compared to other investment vehicles. But, like any investment, ETFs also have potential drawbacks. One is that while they offer diversification, they also expose you to the risk of the entire market sector or index they track. So if the entire sector takes a hit, so does your investment. Also, while the costs associated with ETFs are generally lower than other funds, they are not cost-free. Each transaction comes with a brokerage commission, and there may be management fees too. Let's take an example to illustrate this better. Suppose you invest in an ETF that tracks the technology sector. If the tech sector performs well, your investment will likely grow. But if the tech sector takes a tumble, your investment will likely suffer too. So that's ETFs for you, a versatile tool for diversifying your investment portfolio without buying individual stocks. Now, let's move on to another popular investment vehicle, mutual funds. Just like a potluck where everyone brings a dish to share, mutual funds pool together money from multiple investors. But instead of food, you're sharing investments. A professional fund manager takes this pool of money and invests it across a diverse range of assets. It could be stocks, bonds, real estate, or a mix of these. The idea here is to spread out the risk while maximizing potential returns. So, why are mutual funds a favorite among investors? Well, for starters, it's a simple way to diversify your portfolio. You're not putting all your eggs in one basket, or in this case, one stock or bond. Instead, your investment is spread out across different assets, which can help cushion the blow if one of them doesn't perform well. Another advantage is the professional management. Unless you're a financial whiz or have a lot of time on your hands, researching and managing investments can be daunting. With mutual funds, you're entrusting your money to professionals who do this for a living. But it's not all rainbows and unicorns. Mutual funds do have their drawbacks. They can come with higher fees called expense ratios, which can eat into your returns. Also, since they're managed by professionals, they're not as flexible as managing your own investments. Let's illustrate this with an example. Say you invest in a mutual fund that focuses on technology stocks. If the tech industry does well, your investment likely will too. But if the tech industry takes a hit, your mutual fund will also feel the impact. It's a bit like riding a roller coaster. There can be ups and downs, but you're not the one controlling the ride. In essence, mutual funds offer a hands-off approach to investing, managed by professionals but come with their own set of considerations. Now that you have a basic understanding of both ETFs and mutual funds, you might be wondering, which one is better? There isn't a one-size-fits-all answer to this, but let's break down some key differences to help you make an informed decision. Firstly, let's talk about flexibility. ETFs are traded like stocks throughout the day, meaning you can buy and sell them at any time during market hours. This gives you the flexibility to respond quickly to market changes. On the other hand, mutual funds are traded only once a day, after the market closes. While this might seem limiting, it also means you don't need to constantly monitor the market. Secondly, consider the minimum investment requirements. Mutual funds often require a higher initial investment than ETFs. Some mutual funds require thousands of dollars to start, whereas you can begin investing in an ETF with the price of a single share, which can be quite affordable. Next, let's discuss the management style. ETFs are usually passively managed, meaning they track a specific index. This often results in lower fees as there is less active management involved. Mutual funds, however, are typically actively managed, with a team making decisions about what to buy and sell. This can result in higher fees, but also the potential for higher returns. Lastly, consider the tax implications. ETFs are structured in a way that allows you to avoid triggering a taxable event until you decide to sell your shares. With mutual funds, on the other hand, you could be on the hook for capital gains taxes, even if you haven't sold your shares, due to the fund's internal trading activity. So, which is better? Well, if you prefer flexibility, lower minimum investment, passive management, and more tax efficiency, ETFs might be your cup of tea. But if you don't mind a higher initial investment, prefer professional management, and are willing to potentially pay more in fees for the possibility of higher returns, mutual funds could be a better fit. In the end, the choice between ETFs and mutual funds depends on your investment goals, risk tolerance, and personal preferences. As we wrap up, here are the key points about ETFs and mutual funds you should remember. Firstly, ETFs, or exchange-traded funds, are a type of investment fund and exchange-traded product, traded on stock exchanges. ETFs hold assets such as stocks, commodities, or bonds, and their shares trade close to net asset value over the course of the trading day. The hallmark of ETFs is their inherent flexibility. They allow you to trade throughout the day like stocks and offer a high level of transparency with their holdings disclosed daily. However, keep in mind that while ETFs offer the advantage of lower expense ratios, they can incur trading costs because they are bought and sold like stocks. On the other hand, mutual funds are investment vehicles managed by professionals. They pool money from various investors to purchase a diversified portfolio of stocks, bonds, or other assets. Mutual funds are valued at the end of the trading day and do not offer the intraday trading flexibility of ETFs. They are known for offering professional management and diversification, but they also come with higher expense ratios compared to ETFs. Moreover, the holdings of mutual funds are disclosed less frequently than those of ETFs, typically on a quarterly basis. When choosing between the two, consider your investment goals, risk tolerance, and investing style. If you prefer a hands-off approach and don't mind paying a bit more for professional management, mutual funds might be your cup of tea. If you're a savvy investor who values flexibility and lower costs, ETFs could be a better fit. It's also essential to consider the tax implications of your investment choice. ETFs are generally more tax efficient due to the in-kind creation and redemption process, while mutual funds can generate higher capital gains distributions that are taxable to the investor. Remember, understanding these investment tools is a crucial first step towards making informed investment decisions. Happy investing!